Good morning, guys. Today we're going to be doing year-end accounting procedures. After all posting to the general ledger has been processed, a trial balance is drawn up. This is done to verify the double entry principle. The trial balance does not indicate how profitable the business is, alright? It merely consists of a list of balances of various ledger accounts in the general ledger, as you do know that. In order to determine profitability of a business, a new set of accounts need to be drawn via a trading account and profit and loss account. Although a business is run as a going concern, it is essential to prepare financial accounts for a stated period. It's normally a year, a period of 12 months. In this case, my period will simply be from the 1st of March 2018 to the 28th of February 2019. This period is called a financial year or an accounting period. Basically, the beginning of the year will be the 1st of March 2018. The end of the year will be the 28th of February 2019. In most cases, you will be given the end of the financial year. It is your duty to find when the financial year started. Basically, if your financial year ends on the 28th of Feb, there's a high chance it starts on the 1st of March of the previous year. If your financial year ends on the 31st of May, it starts on the 1st of, if it ends on the 31st of May 2019, it means that it will start on the 1st of June 2018. Okay. Now, a financial year needs to be a period of 12 months. Obviously, there are certain companies that sell non-current assets whose financial year will go beyond 12 months. But from now until grade 12, just know that your financial year will be for 12 months. This period is called a financial year or accounting period. It should be noted that a business does not have to follow the calendar year, that is from the 1st of January 2018 to the 31st of December 2018. It doesn't have to be that way. You can choose any particular financial year that will best suit your business. Most businesses use the financial period that starts on the 1st of March and ends on the 28th of Feb. That is because the financial tax year actually is from the 1st of March to the 28th of Feb. Before final accounts are drawn up, it is necessary to take adjustments into account. Adjustments are simply certain transactions that were not recorded, that are not part and parcel of your trial balance, whatever is in the trial balance. Adjustments consist of entries which have not been considered when the trial balance was drawn up. I did explain that. Example of these adjustments are dealt with below. Adjustments are made to ensure that the matching principle is complied with. Remember, the matching principle requires you to match your income with your expenses for that financial year. Expenses and income are matched for the same time frame. The double entry principle applies to adjustments, meaning that for every debit entry, there should be a corresponding credit entry. Adjustments are recorded by means of a journal entry. Posting are done to relevant accounts and an adjusted trial balance is drawn up. This trial balance is called the post-adjustment trial balance. The trial balance that is drawn up before adjustments have been considered is called the pre-adjustment trial balance. Now we have a pre-adjustment trial balance, and then we're going to have our journal entries for adjustments. Then we're going to post them to the general ledger, and then from there we're going to prepare what we refer to as the post-adjustment trial balance. Now here is one adjustment that we will start with. It is called depreciation. What is depreciation? It is the cost of using the asset. Depreciation is the cost of using the asset. Fixed or tangible assets lose value owing to usage and wear and tear. An item of equipment bought on the first day of the financial period for 10,000 will be worth less on the last day of the financial year. That is because you've been using it. As you use your asset, it will lose value. It may have lost its value by, for instance, 1,000 rand. This is due to wear and tear because when you use an asset or any other item for that matter, it wears out as time goes. The amount by which an asset decreases in value is called depreciation, and I did say it is simply the cost of using the asset. Depreciation is an expense and an indication of the usage of the asset. A part of the asset is being converted into an expense and is an indication of the usage of the asset. So we simply take part of the asset and convert it into an expense every year. Just like your trading stock, when you sell it, you convert it into an expense which we refer to as cost of sales. The conversion of a non-current asset into an expense is called depreciation. A part of the asset is being converted into an expense, that is depreciation. Depreciation of all fixed or tangible asset is recorded at the end of the financial year or period in compliance with two accounting principles. That is the matching principle to make sure that to match the devaluation of the asset to the period in which it is used, and also the rule of prudence. Depreciation reduces the net profit in a particular financial year and it reduces the value of the asset in the balance sheet. Depreciation, it is an imputed expense, that is that portion of fixed or tangible asset which is imputed or attributed or assigned to the specified accounting period, which is regarded as an operating expense. Here is one important thing that you need to remember. Only equipment and vehicles are depreciated. We will not depreciate land and building as their value generally increase over the time frame. Depreciation does not involve an outflow of cash. We do not pay for depreciation. Depreciation is simply a percentage of an asset that we consider to be the true reflection of the usage of that asset, and that percentage will be recognized as an expense in the income statement. Depreciation is recognized as an expense in the income statement. There are two methods of depreciation, that is a fixed installment method and the diminishing balance method. We will consider the two just now. The fixed installment method, this method is also referred to as the straight line method. According to this method, depreciation is calculated in equal amounts over a useful life of the asset, over the useful life of the asset. The useful life of the asset is based on the expected number of years over which we expect to actually use that asset. If equipment costing 10,000 is expected to be used for 10 years, then the useful life of that equipment will be 10 years. Then the annual depreciation on that asset will simply be 1,000 rand, which is just 10,000, the cost of your equipment. You divide it by 10, which is the useful life of that asset. Alternatively, depreciation may be calculated as a fixed percentage of the cost of the asset. Note that under the cost method, depreciation is always calculated as the percentage of the cost price of that asset. This indicates a fixed rate of percentage, and in this case, our fixed rate is simply 10% per annum, which will be applied to value this asset. Let's quickly calculate the depreciation of this asset using the fixed installment method. Well, it was initially bought in the year 2000 at a cost price of 10,000. The depreciation rate will simply be 10%, and for us to get the depreciation, I will simply take the 10,000 rand and multiply it by 10%. Now 10,000 rand multiplied by 10% will simply give you an annual depreciation of 10,000. Accumulated depreciation is the sum of all depreciations. So basically in the first year of usage, accumulated depreciation will be the same as the depreciation for that year, and that amount will simply be 1,000 rand. Carrying value, on the other hand, carrying value, it's simply the cost price of the asset minus accumulated depreciation. The cost price of this asset is 10,000 rand. Accumulated depreciation in that first year of usage will be 1,000 rand. 10,000 rand minus 1,000 rand will be 9,000 rand. In the year 2001, the cost price is still the same. It is still 10,000. The rate of depreciation is still 10%. Depreciation will simply be 10,000 multiplied by 10%, and it will give you 1,000 rand. My accumulated depreciation, however, has changed. Remember, I said accumulated depreciation is the sum of all depreciation. To calculate accumulated depreciation for the current year, I'm going to take last year's accumulated depreciation and add this year's depreciation. By this year's depreciation, I mean depreciation for 2001. You will add 1,000 rand plus 1,000 rand, and it will give you my accumulated depreciation for 2001, which is 2,000 rand. For me to get the carrying value, again, I'm going to take the cost price and minus accumulated depreciation. It'll give me the carrying value for that year, which is 8,000 rand. For 2002, my cost is still the same, which is 10,000. My depreciation rate is still the same, which is 10%. 10,000 multiplied by 10% will give you 1,000. Now my accumulated depreciation has changed. You will add 1,000 rand with 2,000 rand, it will give you 3,000 rand. To get the carrying value, you simply take the cost price of the asset, you minus the accumulated depreciation of that asset. It will give you a carrying value of 7,000 rand. For 2003, the cost price is still the same, which is 10,000 rand. My depreciation rate is still 10%. 10,000 rand multiplied by 10%, it will give you 1,000 rand. Accumulated depreciation will simply be 3,000 plus 1,000. And that will give you 4,000 rand. For me to get my carrying value, I will simply take 10,000 minus 4,000. It will give me 6,000 rand. For 2004, the cost price is still the same. It is still 10,000. Depreciation rate is 10%. 10,000 multiplied by 10%, it is 1,000. Accumulated depreciation will be 1,000 plus 4,000, which is 5,000. Now 10,000 minus 5,000 will give you the carrying value of 5,000 rand. For 2005, cost price is still 10,000. Depreciation rate is 10%. 10,000 multiplied by 10% will be 1,000 rand. My accumulated depreciation will simply be 6,000 rand. I did show you guys it is 5,000 rand plus 1,000 rand. It'll give you 6,000 rand. For me to get the carrying value, I will simply take the 10,000 minus the 6,000. Then it will give me my carrying value of 4,000 rand. 2006, the cost price is still the same, it's still 10,000. Depreciation rate is 10%. 10,000 times 10% is 1,000. 1,000 plus 6,000 is 7,000. That will be your accumulated depreciation. Your carrying value will be 10,000 minus 7,000, which is 3,000 rand. For 2007, my cost price is still 10,000. Depreciation rate is still 10%. 10,000 times 10% is 1,000. 7,000 plus 1,000. To get my accumulated depreciation, it'll simply give me 8,000. To get the carrying value, I will take the cost price of 10,000 and minus 8,000. It'll give me 2,000 rand. For 2008, my cost price will still be 10,000. I will take that and multiply it by 10%. It'll give me 1,000 rand. 10,000 plus 8,000 will give me 9,000. That is for me to calculate my accumulated depreciation. And 10,000 minus 9,000 will simply give me 1,000 rand. For 2009, the cost price is still 10,000. Multiply that by 10%, it'll give you 1,000 rand. Accumulated depreciation will be 10,000 rand. I will actually explain this in detail. According to accounting principle, you are not allowed to have a carrying value of 0. So in this case, you need to limit your carrying value to 1,000 rand. So basically, I need to limit my depreciation for the last year, which is 2009, to 999. 999 is simply 1,000 rand minus 1. Okay, 999 will simply be 1,000 rand minus 1. That is for me to be able to get a carrying value of 9,999, and obviously that will allow me to have a carrying value of 1 rand. How did I get that carrying value of 1 rand? It is simply this: 1,000 rand, you minus your accumulated depreciation of 9,900, it'll give you 1 rand. I repeat, your carrying value may not be 0. It may only be equal to 1. For you to have a carrying value that is equal to 1, you need to make sure that your depreciation does not exceed 1,000 rand, because that 1,000 rand will give you a carrying value of 0. So hence you needed to limit your accumulated depreciation to 1. Now, to limit your accumulated depreciation to 1, you had to make sure that your depreciation for the last year of usage will simply be equal to 999, which is an annual depreciation of 1,000 minus 1. We will get to that in detail later as we go. The cost price remains constant, which is at 10,000 rand. Depreciation is also fixed at 10%, which is when to calculate that depreciation, you will take 10,000 multiplied by 1,000 rand. Always under the cost or the fixed installment method, you will always take the cost price and multiply it by the depreciation rate. Depreciation needs to be apportioned if the asset is only used for a certain period of time. To apportion it means that you're going to multiply it by the number of months over which you have used the asset. Accumulated depreciation, I did show you. It is simply the sum of depreciation of all the asset. It is simply the total of the depreciations that you have added up. At the end of each year, accumulated depreciation on equipment increases by the depreciation amount. Please highlight that because it's very important. The accumulated depreciation on an asset is set up to the balance sheet date. It is recorded in a special account called accumulated depreciation. And you need to know that that special account will simply increase on the credit side, and it is simply the sum of all depreciation. From the purchase or from the date of purchase of the asset until it is either used up or it is sold. The carrying value or book value is calculated as follows. The carrying value is simply the cost price minus accumulated depreciation. It is generally accepted practice that in the last year reflected above, which is 2009, if the asset is still being used, it will be reflected in the books at R1 and will not be depreciated any further. Consequently, depreciation in 2009 will be 999. Now let's do the diminishing balance method. According to this method, depreciation is calculated each year on the reducing book value of the asset, e.g., if equipment consisting of 10,000 is depreciated by 10% per annum, then depreciation for the first year will be 1,000 rand. Depreciation for the second year will be 900. I will specify how we got that 900, which is calculated on the net book value. The net book value is the same as the carrying value. Book value is the same as the carrying value. Book value is the same as the carrying value. And for us to calculate book value, you simply take the cost price of the asset, you minus accumulated depreciation of that asset. Now, this is how we calculate depreciation under diminishing balance method. The first one, the previous table we did, we were calculating depreciation under the cost method. Here we're calculating depreciation under the diminishing balance method. We bought this asset in 1997. The cost price of this asset will be at 10,000 Rand. Depreciation rate is 10%. Depreciation for the first year will simply be 1,000 Rand. Accumulated depreciation in the first year will be the same as the depreciation for the year, which is 1,000 Rand. The carrying value for the first year will be 9,000 Rand, which is the 10,000 Rand minus the 1,000 Rand. It'll give you 9,000 Rand. The cost price in 1998 will still be the same, it'll still be 10,000 Rand. The depreciation rate will simply be 10%. However, under diminishing balance method, we do not use the cost price to calculate depreciation. We use the carrying value. We'll look at the carrying value of the previous year. The carrying value of the previous year was 1,000 Rand. Take that 9,000 Rand and multiply it by 10%. It'll simply give you 900 Rand. 900 plus 1,000 Rand will give you accumulated depreciation of 1,900. Carrying value for 1998 will simply be this 10,000 minus 1,900. That will simply give you 8,100. The cost price for 1999 is still the same. The depreciation rate will still be 10%. However, when we calculate depreciation for 1999, we will simply take last year's carrying value of 8,100 and multiplied by 10%, and that will give me 810. For me to calculate accumulated depreciation for that year, I will take 1,900 plus 810, and that will give me 2,710. To calculate the carrying value for 1999, I'm going to take 10,000 Rand minus 2,710, and I will get 7,290. For 2,000, I will take 10,000 Rand multiplied by 10%. Well, actually, for me to calculate depreciation, I will simply take that 7,000, which is last year's carrying value, multiplied by 10%, and it'll give me 729. My accumulated depreciation for that year will simply be last year's accumulated depreciation plus current year's depreciation, and then it'll give me that. For me to get my carrying value for 1999, I will take 10,000 minus 3,439. It'll give me my carrying value for that year, which is 6,561. To get the depreciation for 2001, I will take this and multiply it by 10%. It'll give me 656. To get the accumulated depreciation for that year, I will take 3,439, add it with 656. To get the carrying value for 2001, take the 10,000 minus the 4,095, and you will get 5,905. Cost doesn't change in 2002. Take 10,000 as it is, and the depreciation rate will be 10%. For me to get the depreciation for 2002, I will take the 5,905 multiplied by 10%, round it up, and I will get 591. Now I will have the carrying value of 4,686, which is a sum of those two, last year's accumulated depreciation plus this year's depreciation. For me to get this carrying value here, I will take 10,000 minus this year's accumulated depreciation, and it will give you 5,314. To calculate the depreciation for 2003, I will take this multiplied by 10%, which is 10,000 times 10%. Well, it's 10% the depreciation rate, but I can't take 10,000 because we're not using the cost method. We are using the diminishing balance method. So I will have to take that, times it with that to get this. To get the accumulated depreciation, it is that plus that. It'll simply give me this. To get the carrying value, I will simply take that minus this, and then it'll give me that. The depreciation, it's simply that times 10%, it'll give you that. To get the accumulated depreciation for that year, I will take that, add it with this, and it'll give me that. To get the carrying value for 2004, I will simply take the cost price minus the accumulated depreciation for that year. It'll give me the carrying value for that year. To get the depreciation for 2005, I will take 2004 carrying value multiplied by 10%. It'll give me 431. Accumulated depreciation is 5,695 plus 431. And my carrying value at the end of the year will be 10,000 minus 6,129. It'll simply give me the carrying value for 2005. And it continues just like that, guys. Now, cost price, which is 10,000, remains the same. It assumed that no new equipment was bought and no equipment was sold. It is generally accepted that depreciation may be calculated to the nearest rand. Concept of materiality applies. Depreciation is 10% per annum on carrying value or book value, and therefore remains decreases each year. It means that it will decrease each year. In the first year, the depreciation expense written off in respect of depreciation is 1,000 rand, and this is identical with the accumulated depreciation, and is also identical to the depreciation under the fixed installment method in the first year. In the second year, the depreciation expense reduces to 900. In the third year, it reduces by a further, to a further 810, etc. It therefore takes much longer longer than 10 years for the book value to be equal to 0. Accumulated depreciation shows the total amount of the depreciation at the balance sheet date, that is at the end of the year. The accumulated depreciation on the asset in the balance sheet date is recorded on a special account called the accumulated depreciation, and the book value I did specify earlier on, it is simply the cost price minus accumulated depreciation. It is generally accepted practice that depreciation will always be, your accumulated depreciation will be limited when your carrying value reaches 1 rand. If depreciation for that year will be limited, okay, it will simply be limited to 1 rand. Classwork is 10.7.